Most traders do not blow up because the market is cruel. They blow up because their decision process collapses the moment price moves fast against them. If that sounds familiar, this video is the reset you have been looking for. We will rebuild your approach around a simple idea proven in the turtle experiment. You do not need to predict. You need to execute rules that compound small edges while cutting risk with machine-like consistency. In the next hour, you will learn how to read breakouts the way a systems trader does, how to size positions so a single loss never threatens your account, and how to pyramid winners without turning them into disasters. You will also install a mental operating system that keeps your hands steady when fear whispers to close early and when greed begs you to add at the top. I will show real numbers, real stops, and the exact if-then checklists I use when the chart turns chaotic. No hype, no signals, just a method that has survived booms, busts, dead years, and the shock of a crash. If you can follow simple rules under pressure, you can be wrong often and still pull ahead. If you cannot, the market will take tuition until you learn. Start fresh today. Bring a notebook. Bring humility. Leave the need to be right at the door. By the end, you will walk away with a repeatable plan, a 90-day blueprint, and a 100-trade challenge that hardwires discipline into your routine. The market will not get easier. You will get stronger. You will see how to translate volatility into units, how to place initial stops, and how to move them as the trend matures. You will practice a simple pre-trade checklist and a post-trade review that rewires habits. This is not entertainment. It is training for real risk. Stay with me. Focus. The origin of this method begins with a question that sounds simple. Can trading skill be taught to ordinary people if the rules are clear and the practice is honest? Chicago, in the early 80s, is the backdrop. Open outcry pits roar, runners weave through crowds, and prices leap while phones ring. Richard Dennis grows a small stake by riding trends with rules that ignore opinions. His friend William Eckhart doubts that such skill can be transferred by instruction. They decide to test the claim in public. A newspaper ad invites applicants who can follow directions under pressure. Thousands respond. A handful sit in a bare training room with binders of precise instructions. The message is blunt. Prediction is optional. Execution is mandatory. You will buy strength and sell weakness when a breakout appears. You will place stops at distances that reflect current volatility. You will risk only a tiny slice of equity on each attempt so that a streak of losses cannot break you. You will add to the trades that work, and you will refuse to average losers. That curriculum becomes the spine of the experiment. The teachers start with simple definitions. Trend following means entering after a move proves itself, not before. A signal is a price crossing a recent high or a recent low. Volatility is measured by the average true range across a recent window. That number is called N in the notes, and it scales everything. A big N means the initial stop is wider and the position is smaller. A small n means the stop is tighter and the units are larger. This translation of chaos into units is the quiet insight that keeps traders in the game. The rules are explained with plain charts. An entry appears. The initial stop is set, a fixed multiple from entry. If price moves in favor by half of n, a second unit is added. If price advances again by half of n, a third unit is added. At each add, the stop for the entire position is raised to protect prior gains. If the trend fails, the exit returns the account to nearly flat with a manageable dent. If the trend runs, the position scales into something meaningful without gambling. The teachers make no promise to remove discomfort. They say most attempts will end as scratches or small losses. They say boredom during flat months is as dangerous as euphoria during runaway moves. They show log sheets that force each student to record rule breaks and impulses resisted. They insist on a pre-trade checklist and a post-trade review. They remind the class that the goal is not to be right today, but to act right for years. The nickname turtle comes from a visit to a farm in Asia where animals are raised in rows. Dennis jokes that traders can be raised in the same way with the right environment and feed. Behind the joke sits a hard belief. Ritual can be taught. Discipline can be practiced until it feels natural. Position sizing turns fear into arithmetic. Stops protect attention by removing catastrophic outcomes from the menu. This is the culture the students absorb. The early results are mixed. Some students follow rules closely and compound steadily. Some bend rules during hot streaks and give it all back. A few quit when long quiet periods arrive, only to watch big trends emerge after they left. The teachers use each outcome as fuel for more training. They point to the way a tiny act of disobedience can erase months of careful work. Skipping one ad because of nerves. Moving a stop because the last trade hurt. Taking a signal late because it looked too obvious. Each small drift is costly. The class learns that the edge is not in a secret entry. The edge is the combination of a simple trigger, small fixed risk, and the courage to scale a winner without apology. Context matters. The experiment happens during a time of large macro moves, yet the logic does not rely on a special decade. It relies on human tendencies that repeat. Herds chase. Information arrives unevenly. Transform, stall, and resume. A rule-based approach does not need to predict any of those steps. It only needs to respond in the same way every time.
That is why this story still speaks to a modern trader who stares at a screen rather than a shouting pit. Today, the order entry is digital and data arrives faster, but the personal battle is the same. Can you let a winner breathe when your pulse is high? Can you cut a loser without bargaining? Can you follow a checklist when a crash headline flashes? The origin story of the method is an answer to those questions. The core rules turn confusion into a routine. First, define your tradable universe. Pick liquid futures, major forex pairs, large cap equities, or leading crypto pairs that trend cleanly and can be executed without drama. Second, define a breakout with no wiggle room. A long signal triggers when today's price trades above the highest high of the last 20 trading days. A short signal triggers when price trades below the lowest low of the last 20 trading days. If you prefer a slower system, you can use a 55-day look-back for entry and a shorter window for exit. But the definition must be fixed before you begin. Third, measure current volatility so risk scales with the market rather than your mood. Use the average true range across the same market to compute a value we will call N. N converts price movement into distance you can use for stops and adds. When N is large, your initial stop sits farther away and your position size is smaller. When N is small, your stop is tighter and the size per unit is larger. Fourth, decide the exact initial stop distance. A common base is 2 times N from the entry price. At that distance, normal volatility should not shake you out. Yet, a larger adverse move will cut the loss before it grows teeth. Fifth, convert account risk into units. Target roughly 1% of current account equity on any new position, so that even a streak of 10 full losses leaves the account healthy and your mind calm.
To turn 1% into units, compute the dollar loss per single unit if the stop at 2N is hit. Divide your planned dollar risk by that number and round down. If the result is 0 or a comic trickle, the market is too volatile for your account today. Sixth, specify the entry order type. A stop order above the breakout level for longs and below the breakout level for shorts lets the market pull you in only if price proves your signal. Do not anticipate with market orders, because impatience costs more than slippage in the long run. Seventh, write the rule for when to add. After entry, if price moves in your favor by 1/2 of N, add an identical unit. If price moves another half N, add again, up to your planned ladder. Eighth, pair every add with a stop update that protects progress. One simple approach is to raise the stop for the entire position to a level that would exit the full size with a small gain if price snaps back. Another approach is to trail the stop behind the most recent swing by a distance based on N. Whichever you choose, set it before the session and apply it without exceptions. Ninth, define exit logic that is as crisp as entry logic. A breakout long can exit on a new low across a shorter lookback, such as 10 days. A breakout short can exit on a new high across that same lookback. Alternatively, you can use a trailing stop equal to 2 times N from the highest close since entry for longs or from the lowest close for shorts. Pick one method and stick to it. You do not invent exits in the heat of the moment. 10th, set rules for special situations so you are not improvising under stress. On gaps that jump over the stop, exit at the next available price and log the slippage without drama. On news spikes that trigger entries and exits in the same session, follow the rules even when it feels ridiculous.
On holidays and thin sessions, treat signals the same unless your backtests prove a persistent edge in skipping them. 11th, handle multiple markets and correlation risk. Several instruments may fire on the same day. Cap total portfolio risk by limiting the sum of all active trade risks to a fixed percentage of equity. Instruments that often move together count extra toward that cap. This cap prevents a single macro theme from dominating your book and protects you during shocks. 12. State your policy on re-entry. If you exit a long on a 10-day low and the very next day price prints a fresh 20-day high, you will take the new signal without hesitation. Choppy markets require repeated small attempts. The goal is not to avoid scratches. The goal is to be present when the one trend that pays for the month finally starts. 13th, ban the most expensive habit in trading. Never average a loser, and never move a stop farther only to delay the pain. If the stop is hit, you are flat. You record the loss, breathe, and reset. Fear will whisper that one more tick of room will save you. 14th, enforce symmetrical courage. Just as you refuse to add to losers, you refuse to skip ads on winners. The system needs you to be smallest when you are wrong and largest when you are right. 15th, write a daily routine so the rules get executed the same way every day. Before the session, you mark breakout levels, compute N, and size units for every market on your list. During the session, you let the market decide. After a fill, you write down the entry, the stop, the ad levels, and the reasons for any deviation. At the close, you review any skipped signals and commit one concrete fix for the next day. 16th, document your rules in language that would make sense to a new assistant. Ambiguity is the seed of drift. If two honest readers could interpret a line two ways, rewrite it until the line is binary.
17th, accept whipsaws as tuition rather than failure. Breakouts will fail often because markets spend long stretches consolidating. It requires consistent risk control, persistent scaling into strength, and exits that give the trend room to speak. You are training yourself to follow price rather than your ego. These are the core rules. Simple on paper, hard in a live account. Execute them under pressure until they become your new reflex. Today. Position sizing is where fear becomes arithmetic. Decide the exact dollar amount you are willing to lose if a new trade fails, convert that fixed risk into a number of units using current volatility, and refuse to exceed that size when emotions surge. Start with a constant risk percent of current equity. 1% per attempt is conservative and keeps you functioning through long strings of small losses. If equity is $50,000, 1% equals $500. Translate market noise into a distance by computing average true range across a recent window. Call that number N. Use a stop that sits 2 times N from entry so that ordinary fluctuation does not eject you, while a larger adverse move ends the trade before damage compounds. The link between risk, distance, and size is direct. Units equal planned risk divided by stop distance multiplied by dollar value per point. In plain text, the formula reads, position size equals account value times risk percent divided by 2 times N times dollar per point. Work it step by step. Suppose you trade a liquid instrument where 1 full point equals $50 per contract. Equity is 50,000, risk percent is 1%, N is 4 points, and the stop is 2N, or 8 points. Dollar loss per contract at the stop is 8 times 50, or $400. With $500 of planned risk, you may hold 1 contract, because 2 contracts would expose $800. If the instrument moves in your favor by half N, you add another contract and raise the stop so that a snapback would still cost no more than the original $500. In equities, the dollar per point is effectively 1. If you buy at 100 and set the stop at 96, your distance is 4. With $500 of planned risk, the maximum shares are floor of 500 divided by 4, which is 125. If price gaps below the stop and fills at 95, you will lose $5 per share, or $625, which is larger than planned. You record the slippage and carry on. In spot crypto, imagine Bitcoin at 60,000 and N at $1,200. A 2N stop sits $2,400 away. With $500 of planned risk, the position equals 500 divided by 2,400, or 0.208 Bitcoin. Most venues enforce minimum increments, so you round down to 0.20. If price rises by half N, you add another 0.20 and raise the stop to a level where a pullback to just under the most recent add would exit the entire stack with a small loss or a scratch. In forex, think in pips and lot sizes. On a pair with the dollar as the quote currency, 1 pip on a standard lot is roughly $10. If N equals 30 pips and you use a 2N stop, distance is 60 pips, or about $600 per standard lot. You could hold 5 mini-lots because each mini-lot risks about $60 at the stop for a total of $300. leaving room to add only if price advances and the stop is tightened. The reason for the percentage method is that it quietly adapts to your health. After a drawdown, 1% is a smaller dollar number, which forces smaller positions until you regain rhythm. After a profitable run, 1% is larger, which allows slightly larger positions without any spur-of-the-moment bravado. This is an anti-martingale posture. You press when you are strong, and you shrink when you are weak. Cap portfolio level risk, so correlated stops cannot ruin a month. Many traders limit the sum of initial risks across all open positions to a fixed ceiling, such as 6% of equity. When two markets tend to move together, count them as a single exposure for the cap, or reduce the second position size by half. The goal is to keep an ugly macro day from knocking you out of the game. Pyramiding must obey the same arithmetic. Add identical units each time price advances by half n up to a pre-committed limit. After each add, move the protective stop for the entire position. A common rule is to place the stop so that if price snaps back beyond the most recent add level by a defined amount, the exit on the full position will be near break-even or a small loss. Measurement details matter. Always compute N with the same lookback that defines your system. Recalculate sizes after each fill using current equity and the latest N. With futures, the minimal size is one contract, so sometimes the correct decision is to pass when distance is too wide. With equities and crypto, you can almost always trade a fractional position, but you still round down to the next permitted increment. Slippage during fast markets will occasionally push losses beyond the planned number. Wide spreads will make adds expensive if you insist on thin instruments. When a gap jumps your stop, exit at the next available price and record the overage in your log. You maintain discipline so the law of large numbers can work. Evaluate trades in R multiples, where 1R equals your initial dollar risk. A 2R win on a $500 risk is $1,000. A minus 1R loss is $500. Grading in R keeps you focused on process quality rather than the raw cash outcome, and it exposes whether wins came from large favorable moves or from a quiet increase in risk per trade. Before the session, you compute N and mark stop distances and add levels for every symbol on your list. You convert the risk percent into units and write the numbers on a card or in a sheet. After the session, you audit the math and the emotions. If you broke size rules, you write down exactly why and the specific constraint you will use tomorrow to prevent a repeat. In the end, position sizing is not about being conservative or aggressive. It is about being consistent enough to let a simple edge express itself. The market will give you clusters of scratches and sudden trends that run farther than seems reasonable. Fixed risk, distance-based stops, and add rules that expand only when price proves you right turn that messy sequence into a survivable curve. You will be smallest when wrong and largest when right. That is the point. Pyramiding lets a small, low-risk probe grow only when the market proves you right. Think of it as a ratchet that moves forward on strength and locks whenever price breathes. You begin with one unit sized by fixed risk rules and a clean breakout entry. The initial stop sits 2 times N from entry, where N is the current average true range, far enough to avoid noise, yet close enough to cut a real adverse move. Pyramiding starts after price moves in your favor by half of N. Add the same unit and immediately lift the stop for the entire position to protect part of the gain. Add again after another half of N, up to a pre-committed limit that fits your plan and your nerves. Every add is paired with a stop update. Be smallest when you are wrong and largest when you are right, but only because price earned it.
Here is a concrete example. You trade a futures contract, where 1 point equals $50. Equity is $50,000. Risk per attempt is 1% or $500. And N is 4 points. A long triggers 1 point above a 20-day high at 100. The stop is 8 points lower at 92, which is 2 times N. Loss per contract at the stop is 8 points times $50, which is $400. So the first unit is 1 contract. When price reaches 102, which is half of N above entry, you add a second contract and raise the stop to a level that would exit near break-even if price snaps back. At 104, you add a third, and at 106, you add a fourth, each time lifting the stop to protect progress. Now follow the win path. From 106, the market trends to 114 over several sessions. The trailing stop sits 2 times N below the highest close since entry, and ratchets upward while you do nothing clever. You do not predict the top. You let the trend work while the stop protects equity. Eventually, momentum fades. The trailing line is hit, and you book a multi-R gain that grew from a small probe. The edge came from scaling only after proof and protecting after every add. Now follow the reversal path. Price hits 106. You hold 4 contracts, and a shock headline knocks price to 102 and under. The stop is hit by design. The position exits close to flat or with a small dent because you tightened the stop after each add. Giving back open profit is irritating, yet it is the tax that keeps you alive through noisy months. In a choppy stretch, you will repeat this cycle often. The system accepts scratches as tuition, so you can be present for the one move that pays for a quarter. Keep pyramiding clean with a few refinements. Fix the maximum number of adds so a position never mushrooms beyond your attention. 2 to 4 adds are common. Keep units equal to simplify decisions. Do not compress add distances because you feel impatient or widen them because you are scared. Let N decide. Always pair an add with a stop adjustment on the same bar. Never add if that fill would push total exposure beyond your portfolio risk cap. Respect correlation by treating tightly linked markets as a cluster when you count risk. Avoid adds during thin liquidity or violent news spikes. For instruments that allow fractional size, round down and avoid accidental oversizing. Recalculate N and unit size after each fill because equity and volatility change. Write add levels and plan stop updates before the session, then let the market pull you in. When a gap jumps your stop, you exit at the next price, log the slippage, and move on. Common mistakes ruin pyramiding. Traders skip adds because they feel late, add too soon because they crave action, move stops wider to avoid a small loss, or switch exits in the middle of a move. They ignore the risk cap and end up with many correlated longs that blow out together. Your defense is ritual. Prepare levels in calm hours, commit in writing, and review deviations at the close with one concrete fix for the next day. The deeper point is that pyramiding is not aggression. It is structure that lets a simple edge express itself without bravado. You are not forecasting how far a trend might run. You are building a staircase only when each step has been tested by price. You outsource courage to movement, risk control to distance and size, and memory to a log. Done well, pyramiding turns a basic breakout into a campaign that grows when the market pays and shrinks when the market punishes. That discipline is what keeps your equity curve rising even though you are wrong often. Let the ratchet click, let the stop trail, and let proof unlock the next unit and nothing else. Pressure does not create your flaws. It exposes them so you can rebuild them into protocols. A loss streak turns a calm plan into a storm of urges.
Bored months whisper that nothing matters and you should press a guess just to feel alive. Sudden success invites guilt and self-sabotage because the new equity curve does not match your self-image. The goal is not to be fearless. The goal is to act correctly while you feel fear, boredom, or euphoria. Start by naming the moment. When a loss hits and your chest tightens, say out loud what is happening. My body is asking me to win it back right now. Then run a tiny sequence that fits inside a breath. Inhale, hold, exhale, and read the line you prepared. If the stop is hit, I am flat. I do not re-enter without a fresh signal. I size the next trade at the same fixed percent. This is a microscript, not a pep talk. You use it because the body listens to simple instructions during stress and ignores long speeches. During drawdowns, you will crave control. Control does not mean prediction. Control means protecting decision quality. Hide your running profit and loss during entries, exits, and management. Check it only at preset review times. You are not refusing information. You are removing a noisy meter that pushes you toward impulsive acts. Replace it with a rule meter that shows yes or no for each checklist item on the current trade. Entry is by rule? Yes. Size by rule? Yes. Stop placed by rule? Yes. If a line shows no, you fix that one line and only that line. Boredom is the silent killer. A month of signals that stop for scratches will poke at your identity. You will feel like a spectator while others post wins. The antidote is structured patience. Set a daily quota of deliberate work that improves the system or yourself when the market offers nothing. Keep the quota small and non-negotiable. When a real signal appears, you will be mentally warmed up rather than hungry for action. Write one line that governs boredom. I do not invent trades to feel progress. I earn progress by obeying the next signal completely. Success has its own demons. After a fast run, your mind may whisper that you did not deserve it or that you will give it back. The cure is to anchor identity to behavior, not to dollars. Define who you are in verbs. I prepare. I size. I add. I exit. Read that before the open and after the close for a week. If guilt still bites, reframe the role you play. You are paid to be a reliable operator of a simple rule set, not a visionary hero. Heroes blow up. Operators show up. Social inputs matter more than you admit. Mute accounts that trigger envy or frantic copycat trades. Follow builders who document process, mistakes, and fixes. Keep a tiny circle that will tell you when you drift. Ask them to call you out on the exact behavior you want to kill. For example, ask a friend to message you if you post intraday P&L screenshots, because that is your personal red flag for future size creep. Design your environment so good choices are easy. Put the checklist where your eyes land before you click. Set your platform to ask for confirmation if an order would exceed your risk cap. Preload ad levels and stop updates so you are executing a plan rather than calculating when adrenaline is high. Use session alarms at times you tend to get sloppy. At the alarm, read a single sentence. Am I following the plan this bar? When panic hits hard, shrink the battlefield without shrinking into avoidance. Keep the risk percent the same, but reduce the number of markets you monitor for a few days. Less noise means fewer urges. If you overtrade when tired, enforce a hard stop time and a short walk before the last hour. If you chase after a news spike, add a rule that any trade triggered within 2 minutes of a headline must be confirmed by a close above or below the level, not just an intrabar poke. Post-trade review is where you rewire. Do not journal your feelings in paragraphs.
Score behaviors in simple fields. Did I take every signal? Did I skip any ads? Did I move a stop? Did I check P&L outside review times? Each no becomes one micro-experiment tomorrow. For example, if you moved a stop, tomorrow you must take a screenshot of every stop placement and paste it into the log before placing the order. Add friction to the mistake you want to remove. Use if-then rules for the moments that always hurt you. If I hit 3 full R losses in a day, then I stop trading and run my recovery routine, because my edge comes from long series, not from one afternoon. If I feel the urge to double size to win it back, then I close the platform for 10 minutes and write the exact reason that urge thinks it will help. If I catch myself editing rules mid-trade, then I copy the line into a fix file and commit a rewrite after the close, never during the fight. Finally, practice on purpose. Role-play the bad day. Print a chart with a fake crash. Read your microscripts out loud and click through the steps. Practice adding while your heart rate is up. This sounds silly until you try it and watch your hands calm down. That is the point. You are building automatic behaviors to carry you through chaos. Pressure will still come. Your edge will still be small. But your actions will be stable. And that stability is what turns a fragile plan into a durable career. Most trading errors share one root. Emotion tries to overrule rules at the moment they matter most.
The system path decides in calm hours and executes like a checklist when risk goes live. The emotional path improvises and treats every trade as a special case. Oversizing often follows a hot streak. After a win, the mind whispers that this setup deserves more size. The system path keeps risk per attempt small and constant as a percent of equity and turns volatility into distance. The emotional path guesses and rounds up. Print your unit math where you click and refuse orders beyond that number. Skipping signals follows cold streaks. Several breakouts fail, doubt grows, and the next valid trigger is ignored. The system path takes every signal because real trends do not announce themselves. The emotional path waits for extra confirmation and then chases late. Cue stop orders before the session so price must earn the fill. Filter creep begins as craft and ends as paralysis. You add conditions until only the past fits. Backtests look perfect and live trading disappears. The system path keeps a few robust definitions and judges success across large samples. The emotional path edits rules during drawdowns and calls it improvement. Lock rules between review dates and write one reason for any change. Averaging losers is the classic wound. The system path never adds to a losing position. It exits, logs the loss, and resets. The emotional path insists the market is wrong and must return. Read a promise before the open. If the stop is hit, I am flat and I do not re-enter without a new signal. Moving stops wider is the cousin. Price approaches the stop and you grant extra room to avoid pain. The system path accepts the dent and preserves attention for the next trade. The emotional path negotiates with the market and turns a dent into a crater. Taking profits too early mirrors averaging. After a string of scratches, a winner appears and you grab a small gain to feel safe. The system path adds by plan and lets a trailing stop protect progress. Grade results in risk units, so a small cash win that breaks rules registers as a red mark. Correlation blindness hides inside good days. Many instruments fire on the same theme, and the book becomes one large bet. The system path caps the sum of initial risks and treats linked markets as a cluster. The emotional path believes it is diversified and pays during shocks. Compute a portfolio risk number before entries and refuse to exceed it. Revenge trading is a fast spiral. A sharp loss hits pride and the next order tries to get even. The system path pauses after a set count of full losses and runs a recovery routine. Install friction. After any full loss, take a screenshot, paste the rule line into the log, and wait before another order may be sent. News bias bends both ways. A headline arrives and you skip a clean breakout, or you chase a rumor and ignore distance and size. The system path treats signals the same on news days and logs slippage without drama. Trade the plan and journal the event. Curve fitting flatters the ego. You discover a filter that rescues the last 100 trades and declare victory. The system path validates on unseen data and accepts rough edges. The emotional path clings to perfect past curves that shatter live. Maintain a holdout period and a minimum sample before any change ships. Fatigue turns skill into noise. Tired eyes miss ads and misread levels. The system path enforces a stop time and a short walk before the last hour. Protect the operator so the operator can protect the trade. All errors reduce to one fork. Do you want to feel right now or to act right for years? Map each weakness to a simple if-then line. If I skip an ad, then I rehearse the level and take the next one without delay. If I move a stop, then I step away for 15 minutes and rewrite the sentence that allowed it.
If I hit 3 full losses today, then I am done for the session, because my edge lives in long series. Ask a small circle to call you out when you drift, and thank them when they do. The system path feels boring in the moment and brilliant in the data, which is exactly why it works over long series. Modern tools exist to reduce improvisation, not to replace judgment. Think in 3 operating modes that you can switch between as your skill and account grow. Full auto means the computer scans markets, sizes units, sends orders, moves stops, and logs everything without your click. Semi-auto means the computer does the math, shows exact levels, and stages orders that you confirm. Hybrid means the system places entries and initial stops by rule, while you confirm adds and exits during special conditions such as thin sessions or major news. None of these modes are superior in all cases. The right choice is the one that keeps your rule execution clean when pressure is high. Begin by turning volatility and risk into numbers with a small script. Pull daily data, compute average true range as N, and translate 1% of current equity into units. Have the script print entry price, stop distance, ad levels at half N steps, and the dollar risk per unit. Put that output where your eyes land before you act. Next, add a position reconciler. It reads open positions from your broker or exchange and compares them with your plan. If anything is off, it warns you before the session starts. This simple cross-check kills many expensive errors. Build a checklist runner that turns each rule into a yes or no switch. When a signal fires, you should see clear flags for entry by rule, size by rule, stop placed, ad level staged, and portfolio risk under the cap. If any flag is red, you fix that line before sending anything. Layer on risk breaks that operate even when you are tired. Install a daily stop after a set number of full risk losses. Enforce a maximum total initial risk across all open positions. Require confirmation if an order would raise exposure in a correlated cluster. Set an alert when slippage or spread exceeds a threshold so you can pass on thin conditions. Monitoring is an operating job, not a heroic act at the screen. Decide review cadence in calm hours. Prices and signals update often, but humans do not. For most swing traders, a morning review, a midday check, and a close review are enough. In full auto, you still watch for broken data, venue outages, and rejected orders. Use heartbeats to confirm that data and order routes are alive, and raise a loud alert if a heartbeat fails. Failure modes are predictable. Data can be delayed or wrong. Symbol mappings can change. Clocks can drift a few seconds and turn a clean stop into a messy fill. Network hiccups can split your position into what the broker sees and what your sheet believes. Orders can be partially filled around ads and leave you with an odd size. Prepare first aid for each failure before it happens. Keep a kill switch that cancels working orders and flattens positions. Keep a manual sheet to rebuild sizes and stops if the platform crashes. Keep broker contacts and 2 different networks ready so you do not fight the market and your connection at the same time. Version control your rules. When you change a parameter, record the date, the reason, and the evidence. New logic ships in shadow mode for a week, where it prints signals to a log without placing orders. Only after a clean shadow week does it go live, and even then it begins with tiny risk. This practice removes the urge to edit a system during a drawdown. Logging is where your discipline becomes visible. Log every entry, stop change, add, exit, and deviation with a single line reason. At the close, run a reconciliation that proves the book matches the plan and that portfolio risk never exceeded the cap. Save stops under memory at decision points, so future reviews are not colored by memory. Migrate carefully from manual to automation. Start with calculators and checklists. Move to staged orders that need your click. Promote only the parts that are stable and simple to full auto, such as initial stop placement and trailing stop updates. Keep ads under manual control until you trust your alerting and your reconciler. The goal is not speed. The goal is fewer decisions in hot moments and more decisions in cool moments. When the machine handles the arithmetic and the scaffolding, your attention is free to do the single human job that remains. Protect the rules while the market tests your nerves. Crypto is not a different planet. It is the same game played in a faster weather system, with round-the-clock sessions, fatter tails, and new types of venue risk. You keep the spine of the method exactly the same. Breakouts define entry. N translates chaos into distance. Fixed risk turns fear into arithmetic. Pyramiding grows only when price proves you right. What changes is the way you measure, the way you pay costs, and the way you defend against exchange-specific hazards. Start by defining time. Because crypto trades without weekends, you must choose a daily boundary and stick to it. Use midnight universal time, or the daily close your data vendor defines. Your 20-day high, low, your exits, and your average true range must reference the same calendar. If you work faster, consider a 4-hour bar system that still uses the same N-driven logic. Pick one frame and keep it consistent, so signals are stable. Volatility in crypto breathes wider than most futures and equities. That is fine, because N absorbs it. What matters is a hard volatility cap that tells you when to stand down. If the ratio of N to current price is so large that a 2N stop turns your unit size into a rounding error, or forces you to use leverage just to reach a minimum size, you pass. The method wants you alive for the next clean phase, not heroic during a spike. Recompute N daily and after fills. Many coins go through regime shifts where N doubles in a week. Your size should shrink automatically with it. Funding and fees are the invisible taxes of perpetual swaps. Before you take a signal, check the current and recent funding rate. If funding is sharply positive and you plan to be long, treat it as negative carry and bake it into the expected path. If funding is negative and you plan to be short, treat it as a mild tailwind. Set a personal cap on funding drag per day. If the cap would be exceeded, skip the trade or choose a spot venue with a hedge in futures that keeps carry near flat. Maker and taker fees also matter because pyramiding turns many small orders into real cost. If your plan adds at half end steps, use limit orders where depth allows and accept taker fees only when momentum risk outweighs Q risk. Margin is not a tool for more size. It is a way to allocate capital across venues while keeping liquidation far from your stop. Use isolated margin so a single position cannot drain the entire account. Place real stops on the venue and have a server-side stop with a broker or a second venue as a backup. Never delegate risk control to a liquidation engine. Your stop exits by rule long before any liquidation line becomes an issue. Liquidity is uneven across pairs and hours. Focus on instruments with deep books and reliable spreads. During thin periods, widen your expected slippage and reduce the number of planned adds. If a news shock turns the book into a gap stare, skip fresh entries until depth returns. Your advantage is patience and rules, not speed. Custody and venue risk are part of the crypto landscape. Diversify operational risk across at least 2 reputable exchanges, and keep cold storage for capital that is not needed for near-term margin. Stabilize your quote currency. If you measure equity in dollars, minimize exposure to fragile stablecoins and know your conversion routes. Keep records of deposits, withdrawals, and balances the same way you reconcile positions. In a venue outage, your log should let you rebuild stops and size within minutes. Signals, adds, and exits stay the same. A long prints when price trades above the highest high of your chosen window, and a short when price trades below the lowest low. Add at half-end steps and move the stop for the entire stack after every add. Exit on a shorter window break or a trailing end multiple. Accept scratches in chop and be present for the rare clean runs that crypto still delivers. Your job is not to tame volatility. Your job is to translate it into distances and units and to survive long enough to let a durable edge show itself. 90 days is enough time to turn a scattered approach into a reliable operating routine. The purpose of this plan is not to chase a quick win. The purpose is to build a repeatable way to trade that survives quiet weeks, sharp reversals, and your own urges. You will finish with a stack of executed rules, a clean log of decisions, and a body that stays calm enough to act when a real trend appears. The first 10 days are for building the scaffolding. You write your rules in plain language so that a new assistant could follow them without guessing. You choose a fixed risk percent per attempt, you define your breakout window, you define how you compute volatility as N, and you write the exact distances for stops and adds. You build a small calculator that turns equity, N, and dollar value per point into units. You set a portfolio risk ceiling so that correlated positions cannot push your total initial risk beyond your comfort. You rehearse the routine with historical charts. You practice placing entries at breakouts, moving stops by distance, and adding at half-end steps. You log each rehearsal with the same fields you will use live. You are not trying to be perfect. You are trying to make the process feel familiar. Days 11 through 30 are your tiny risk phase. You go live with real orders at a fraction of your planned risk. If your long-term plan is 1% per attempt, you begin at half of that. You take every clean signal in your defined universe. You do not filter because you feel cold or hot. You let price pull you in. You add only when the half-end step is earned. You move stops the moment an ad fills. You grade each decision with a rule adherence score. Entry by rule, size by rule, stop by rule, ad by rule. Portfolio risk under the cap. You do not judge yourself by dollars. You judge yourself by the count of yes lines. Days 31 through 60 are for steady state at your planned risk. If your rule adherence score across the first 20 trades is strong, you step up to your normal risk percent. You keep the same universe and routine. You enforce your daily stop after a fixed number of full losses. You hide running profit and loss during entries, exits, and management. You only check cash results at your review times. You are teaching your nervous system that action follows rules, not emotions. Days 61 through 90 are for expansion without drift. You add markets only if your portfolio risk tools keep the cap intact. You automate the arithmetic pieces you now trust. You keep ads simple and equal. You do not invent new filters mid-run. You schedule one review day near the end of each 10-day block. On that day, you may propose a single small change to your rules with clear evidence. All other days are for execution. Your daily cycle is simple. Before the session, you compute N for each symbol, mark breakout levels, mark ad levels at half-end steps, and convert risk percent into units. You check portfolio risk across all staged orders to confirm the cap will not be broken if everything fills. During the session, you let the orders sit and you do not touch stops or ads except by rule. If a gap jumps a stop, you exit at the next price and log the slippage without drama. After the close, you reconcile positions with your plan and score adherence lines. If a line is no, you write one sentence that explains why and one sentence that states the fix you will apply tomorrow. The weekly review turns data into improvements. You scan your log for repeated drifts. You sort trades by R multiple rather than cash, so you can see whether wins came from clean trends or from secret size creep. You pick one habit to reinforce and one mistake to remove. You rehearse the fix with a short role play on a saved chart. You keep the review short, concrete, and boring. Board work today prevents exciting disasters next week. The 100 Trade Challenge is your pressure test. The rule is simple. You will take 100 valid signals with your defined entries, fixed risk, distance-based stops, and half-an ads. You will not edit rules mid-challenge. You will not skip a clean signal because of mood. And you will not add a filter to avoid discomfort. You will log each trade with date, market, entry, stop, ad levels, exit, final R multiple, any deviation, yes or no, and a single emotion label. Passing the challenge does not mean you make a certain sum. Passing means you execute at least 95 of the 100 trades without a rule break. You keep your portfolio risk under the cap, and you respect your daily stop after a fixed count of full losses. If the pass rate drops, you pause after the current day and run a recovery block of 5 rehearsal days on historical charts. You treat the challenge as a lab that reveals your tendencies, not as a tournament. To keep the challenge honest, you remove little traps. You prevent yourself from checking running profit and loss outside review windows. You install a confirmation that blocks any order that would exceed your unit count. You create a small reconciling script that flags mismatches between your plan and your open positions before the session. You ask one peer to glance at your log each week and call out any drift in plain language. You say thank you when they point at a flaw.
You will face cold streaks during the challenge. When you take 3 full losses in a day, you stop. You walk, drink water, and read your microscript. If the stop is hit, I am flat. I do not re-enter without a new signal. I size the next trade the same. You return the next day and obey the plan. You will also face a fast run of winners that tempts you to double size or to take profits early. You answer with symmetrical courage. You refuse to increase risk because of euphoria, and you refuse to skip an ad because you feel blessed. Your edge lives in large numbers, not in a single hot afternoon. Your log is the engine of change. You keep screenshots at entry, first ad, and exit so future reviews are not colored by memory. You mark the time between signal and order so you can see whether hesitation is stealing fills. You tag trades that cluster around the same macro theme so you can judge correlation honestly. You write one line per trade that names the lesson without drama. I skipped the second ad because of news. Tomorrow I will stage the order before the open and take it without discussion. At the end of 90 days, you read the whole log in one sitting. You will see that profit came from a few stretches where you were simply present and brave in a boring way. You will see that most losses were small and that the expensive ones came from drift.
You will commit to one structural change if the evidence is strong, such as a tighter or looser exit window, or a small change in the universe. You will also write a paragraph that defines who you are in verbs rather than outcomes. I prepare, I size, I add, I exit, I review. That identity is the quiet asset you have been building. The plan is not glamorous. It is a practical path from confusion to competence. 100 trades taken by rule. 90 days of simple routines that protect decision quality. A body that stays steady enough to let a simple edge express itself. You do not need permission. You need a calendar, a log, and the will to obey laws you wrote in calm hours. Start now. You have everything you need to start now. Do not wait for a perfect system or a quiet market. Pick your universe, compute N, fix your risk percent, stage your orders, and let price decide. If you want a hand to stay consistent, join the Mind Over Markets circle. It is a small group who practice the same rules, share clean logs, and call out drift. We post chart snapshots at entry, after each ad, and at exit. And we grade every action by rule rather than by dollars. You will get a 90-day blueprint template, a 100 trade tracker, and a checklist to keep beside your screen. In return, you bring honesty about your decisions and the willingness to run the next signal by the book. If this video helped, subscribe and share it with one trader who needs structure more than tips. Then commit to one action before the next session. Mark your breakout levels. Compute N. Write your unit size. When the bell rings, you execute what you wrote. After the close, you reconcile your book, score adherence, and log one fix for tomorrow. This is how we grow a small edge into a durable practice. The market will not slow down for you. Build your ritual. Protect your risk. Help another trader do the same. And meet us inside.